You take 50 cents out of someone's wallet every week. Not much, right? They probably wouldn't even notice. But if you did that to 1 million people, that's $500,000 a week. Over $26 million a year. From half a dollar. Banks noticed, and they've built an entire business model around it. My name is Dave, and I spend way too much time thinking about how the smallest charges quietly become the biggest drains on your wealth. This one's for anyone who's ever looked at their bank statement, seen a bunch of tiny fees, and thought it's only a few dollars. If this clears things up for you, you'll probably like what we do here. And if it helps, tap the like button. More people need to see how this works. Let me show you something most people miss. There's this idea that responsible adults pay a small price for banking services. Account maintenance, overdraft protection, ATM convenience. It's like paying for Netflix or your gym membership. You use the service, you pay a little fee. Fair exchange. And honestly, that sounds completely reasonable. Banks aren't charities. They provide a service, keeping your money safe, letting you access it anywhere, processing your payments. That all costs money to maintain. So a few dollars here and there, that's just the cost of modern life. Even financial advisors will tell you, focus on the big stuff, housing, cars, investments. Don't stress over a $3 ATM fee. Totally logical, totally normal, totally expensive. We've been conditioned to see bank fees as background noise. They're not dramatic. Nobody loses sleep over $12 a month in service charges or a $35 overdraft fee once or twice a year. It's also autopilot money. The fees just disappear from your account. No decision required. No painful swipe of card. No transaction to remember. It's passive bleeding, which means it never triggers that mental alarm that yells, "Stop spending." There's also this weird trust thing happening. Your bank sent you a 47-page disclosure when you open your account. You didn't read it. Nobody does. But the fact that it exists makes you feel like everything's been explained. Like you agreed to something official and legitimate. Plus, switching banks feels like a hassle. New account, new card, updating direct deposits, moving automatic payments. So you stay. And the fees stay too. Let me walk you through what actually happens with some real dollar amounts. Imagine you have a typical checking account. It charges $12 a month for account maintenance, unless you keep a minimum balance of $1,500. You also use out-of-network ATMs about 3 times a month at $3 per transaction. And once this year you overdraft by accident and got hit with a $27 fee. Let's add it up. $12 per month maintenance fee is $144 per year. $3 ATM fees times 3 times / month times 12 months is $108 per year. One $27 overdraft fee is $27 per year. Total, $279 per year in bank fees. Now, that might not sound catastrophic, but think about it differently. If you invested that $279 every year for 30 years at an average 7% return, you'd have over $26,000. You're not losing $279. You're losing $26,000 in future wealth. For what? Convenience you could get for free at a different bank. Banks collected an estimated $12.1 billion in overdraft and NSF fees in 2024 alone, according to updated data from the Financial Health Network. That's billion with a B. And it's not spread evenly. Research shows that about 9% of account holders pay the majority of these fees. They're not rich people making careless mistakes. They're people living close to the edge, one unexpected expense away from going negative. The average overdraft fee is around $27. But here's the sneaky part. Banks can charge you multiple overdraft fees in a single day. Buy coffee for $4, lunch for $8, gas for $20, all while your account is $5 short. And you could rack up 3 separate $27 fees. That's $81 in fees on $32 of purchases. Even worse, some banks reorder your transaction from largest to smallest to maximize overdrafts. You think you overdraft once. The bank's system says you overdraft 4 times. JP Morgan Chase alone made over $1 billion from overdraft fees in 2024. Wells Fargo made roughly the same amount. 2 banks. $2 billion. From people who didn't have enough money in their accounts. Picture someone, call her Jen. She's 29, works in marketing, makes about $52,000 a year. Not rich, not struggling, just normal. Jen banks with a major national bank because that's where her parents banked. She's had the account since college. Never thought much about it. Every month, her account gets dinged $12 because her balance dips below $1,500 for a few days. She uses ATMs when she's out, whatever's closest, and pays $3 each time, maybe 4 times a month. One month, her car insurance auto-drafts a day earlier than usual. Her paycheck hasn't hit yet. Overdraft, $27 fee. Jen doesn't freak out. It's annoying, but it's not a crisis. She makes the money back in a day. Life goes on. But over the course of a year, Jen pays about $350 in various bank fees. She's never added it up. If you asked her, she'd probably guess it was $100, maybe $150. Meanwhile, her friend switched to an online bank with no fees. Zero. Same services. Same FDIC insurance. Same access to money. Just no fees. Jen knows this. But switching feels like a project. So she stays. And every year, $350 disappears. Over 10 years, that's $3,500, gone for nothing. The trap isn't one big fee. It's the pattern of small, repeated charges that never get questioned. You see it everywhere. The $12 monthly fee, the $3 ATM charge, the $27 overdraft, the $10 paper statement fee, the $5 low balance warning fee, the $15 wire transfer fee. Each one is small enough to ignore. But together, they're designed to extract hundreds of dollars a year from millions of people who won't do the math. And the pattern works because it targets your inertia. Changing banks requires action. Fees require nothing. They just happen. So you stay, and they keep charging. Banks used to make money by lending your deposits at higher rates than they paid you. That's still true. But fee income has become a massive profit center. Why? Because it's predictable, it's automatic, and most people won't leave over it. You might think, but I need overdraft protection. What if I actually need to make a purchase and I'm short? Fair question. But here's the thing. Overdraft protection isn't protecting you. It's protecting the bank's ability to charge you a fee. Most banks let you opt out of overdraft coverage entirely. If you do, and you don't have enough money, the transaction just gets declined. No fee. You might feel embarrassed at the register, but you don't lose $27. Or you could link your checking to a savings account for real overdraft protection. Many banks charge $0 to $5 for an automatic transfer instead of $27 for an overdraft fee. The protection language makes it sound like they're doing you a favor. They're not. They're charging you $27 to cover a $4 coffee. That's not protection. That's a payday loan with a 675% interest rate. Instead of giving you steps or advice, just ask yourself a few things. Do I actually know how much I paid in bank fees last year? Not a guess, the real number. Go look. Is there a bank or credit union that offers the same services I use without charging fees? Spoiler, yes, there is. Am I staying with my current bank because it's actually better, or just because I haven't made time to switch? If I took every dollar I've paid in bank fees over the past 5 years and invested it, how much would I have right now? What's the real reason I haven't opted out of overdraft fees yet? Those questions will tell you more than I ever could. Bank fees aren't the cost of banking. They're the cost of not paying attention. Free checking exists. Fee-free ATMs exist. Banks that don't charge overdraft fees exist. You're not stuck. You're just there. And theirs expensive. Banks made $12.1 billion in overdraft fees alone in 2024. That money came from regular people. Not millionaires, not people being careless, just people living paycheck to paycheck who got caught short. Add in ATM fees, maintenance fees, and all the other little charges, and you're looking at an industry that profits massively from tiny, invisible drains. The trap works because each fee is small enough to justify. But over time, you're not losing $12. You're losing years of compound growth on money that should have been yours. You don't have to accept it. You just have to notice it. Share this with someone who's still banking with the same place, they open an account in college. Or someone who complains about fees but never does anything about it. Even if this didn't surprise you, someone you know is losing hundreds a year and doesn't realize it. And if you're wondering what happens when people finally wise up to bank fees and move their money, well, that's when they discover the next trap. Because even when you're trying to pay off debt responsibly, there's something banks quietly hope you never figure out: the minimum payment trap. Why does making your minimum payment every month, the thing they tell you to do, actually keep you in debt longer and cost you thousands more? Why do credit card companies make the minimum payment option so easy to choose? And what happens when you realize that responsible minimum payments might be the most profitable trap they've ever designed? That's exactly what I break down in the next video. The minimum payment trap explained with cartoon. Once you see how it works visually, you'll never look at a credit card statement the same way again. If you found this helpful, you know what to do. And I'll see you in the next one.